Hey everybody, this is David Skarica. So we're going to look at here in stock chart of the day. Today we're going to look at banks, and then tomorrow we're going to look at kind of bonds. Because one of the issues right now, as you're going to see with these banks, is that these bonds have fallen so much in price, and bonds are considered, like a safer asset class, especially investment grade bonds and government bonds. But the issue is they've just fallen too much in price, right? Um, is that the banks are now sitting on huge losses. So we can see this here, and this is what Twitter is really good for. And again, by the way, I've opened up my Twitter account; it's no longer locked. So it's just Twitter at the .com/ at David Skarica, my name. Just so you know, because I have launched that football site, Raider Greats or blog. That I do have posts there too, but it's still mostly my financial newsletter. I've just combined the two because I don't want to bother having a million sites, et cetera, et cetera. And this Raider blog is really something I'm doing for fun. I post a couple short articles every week. And like I said, if you're interested in football, you can read that too. But anyhow, this is where you can see that banks, 25% of their unrealized gain loss as a percentage of their equity capital, is like they're now sitting on near 25% loss as a percent of equity capital. And we can see in 2008, that only hit like 5%. So, and these are securities that they have held, right? So, and that's because bonds have gone down so much, and they haven't had to market them, right? So these are the ones that are available for sale. These are the ones that if they're held to, and if these securities are held to maturity right now, you can see the losses get even bigger, right? So this is unbelievable, and a sign that we could be entering another major banking crisis, because of what the Federal Reserve has done with interest rates and with bonds dropping. So one of the warning signs, I talked about this in the past, is we can see the banks have acted very poorly. We can see the BKX is down actually almost 50%, from 150 to about 76, 75 from its highs. And of course, the S&P is down nowhere near as much. The S&P, which peaked at 4,800, is now about 4,300. So that's just over 11%. And that's always a warning sign. That's, again, I'll show you a historical chart. That's what happened in 2007, 2008, is that even kind of while the S&P held up in the first phase of the financial crisis, the banks were rolling over, and it was a really bad warning sign. And of course, if we look at the regional banks, this is the KRX, that's a shorter term chart. We'll get a longer term chart. It's even worse because they're kind of more in the epicenter this time. You can see the regional banks too are down, a huge amount here, as well, right? Since 2022, right? So this is, a real issue. So one of the ways I'm playing this before, and I have been for a while, one of my larger shorts is the SKF, which you can see is started to move up here. My average price is probably in that 18 to 19 range. So I'm just starting to make a little bit of money. And again, because we are in October, because we are seeing interest rates go higher, maybe I'll talk about that tomorrow in my stock chart of the day where we show these bonds. I just never like when these rates are spiking in the summer and in September going into October, because that's what's happened in a lot of these crashes, 29, 37, 87, etc. The bond market begins to roll over first, and then stocks, for whatever reason, are always kind of the last ones to know. Maybe because of just younger people are always in stocks. One of my subscribers mentioned that to me, and maybe because so they're not looking at the macro pictures. They just think they're going to make all the money in the market or whatever. So I don't know why that is, but that's definitely seems to be a case here going forward. So now we're going to go look at because we saw the banks here. So, okay, now we're going to go look at the banks compared to the S&P. So again, if we go like BKX divided by SPX, we'll get a 2-year chart. So we'll see, since the market topped out 2 years ago, especially earlier this year, you can see the big decline. And that's what's dangerous right now. Notice like they had the first decline in 2022, kind of went sideways for a while, and then had this other tank. Well, is this going to happen again, where they really underperform, but the whole market would fall, just the banks would fall faster if that's the case. So, but you can see, the banks have vastly underperformed. They've gone from 0.03 on the of the, so 3 cents of the S&P 500 to 0.18. So they've actually underperformed the S&P by 40%. And if we go back to 2007, you'll see the exact same thing started happening then. That in 2000, we'll actually go back to 2006, and we'll end this chart in 2008 during the financial crisis. And what we'll see is that you can see the BKX, which peaked at, back then it was 8 cents. Remember the market top tier in October, it was 6.5 cents. So that 2.5 divided by 8, roughly, that's roughly 30%. So the BKX underperformed the S&P by 30%, and that of course led to the huge crash. Now you can see actually during the crash in October of that year, again, stocks kind of caught up to the banks, right? But until July of 2008, you can see that banks had underperformed the S&P by almost 50% from their highs in early 2007. And the real thing was this whole move in 2007 was a warning that something was going to happen, because you can't have a bull market without the banking sector, participating. So let's just go look at each individual chart, and we can see the BKX again, which peaked at near 120 in early 2007, was, nearly 80 by the end of the year, and then eventually went to 35 by the end of 2008. So you can see, this was a huge problem for the market. And if we look at the S&P, again, in October, the S&P made a new high. The BKX is actually even underperforming worse now, believe it or not, than it was back then. The BKX, you can see, was like 20% or 15 to 20% below its highs in October. And you can see the S&P was at a new high. But again, the banks not participating were a real warning sign. And if we go look at some, in Canada, where of course we've had this huge real estate bubble, look at Royal Bank, right? All these banks in Canada are breaking down. There's Bank of Montreal's right at its lows. And if we get let's go to 2-year charts. You can see Royal Bank broke down. It's near its lows of last year, but it's remember that was late October. So if it hangs around here the next month, these will be near 52-week lows. So it's almost near 52-week lows, because other than that little spike lower in mid-October, it's down. And then again, BMO, again, they're not quite at the lows here, but you can see BMO has this real support here at 81, and it could roll over. CIBC. One second, let me get to TD Bank. Let's say TD Bank. And same thing here. You can see that they've all come down a lot, and they're kind of at these short-term support levels. And but again, you can see they're all close. Again, we get a 3-year chart of TD Bank. They're all close to these lows that were hit in 2022. And you can see a TD Bank breaks this 55. It's probably going back to almost where it was in 2020, right? And because these banks have gone up so much, you can understand Canada only has 5 big banks. So, and because they've gone up so much, and especially with the real estate boom in Canada, they make up a huge percentage of the Canadian stock market. And maybe that's one reason the Canadian dollar, for example, is not really rallying even with higher oil prices, because the financial sector now is much more part of the Canadian economy than the resource sector. So maybe that's a real sign that the dollars may be trading more with the problems in the financial sector. And as bad as that US financial sector is that I showed, the Canadian one is, again, even kind of worse, because housing as a percentage of GDP, the average housing costs are much higher in Canada than they are in the States. And I don't want to digress too much for that, but I just wanted to show you that these banks, again, underperforming here and kind of breaking down here. Again, other than this secondary move down in May, the banks are essentially at their lows now, and you can see this whole move that happened really, during the boom of 2020 and 2021 is been taken away, we're talking, these are big cap banks, and they're down almost 50% in just about, 20 months. So anyhow, interesting to see. I guess I'm going to leave it at that. And we'll have to see what happens. Like some of this stuff just makes me scratch my head. I'll talk about maybe tomorrow more when I talk about interest rates, but this is one of our shorts. It was down to almost 1% today, but like for these housing stocks to be where they are with interest rates where they are, with the banks where they are. And I know there's a lot of this where they're selling these houses en masse to the BlackRocks, to the Blackstones of the world. We're going to then turn just, rent them out. But still, like, there's no reason for this. Like, there's no reason that these things should not be lower. And they're like, you see how much they're up from their highs. Like many of these stocks earnings year over year are still down like 20-30%, and the stocks are up 100%. And I know markets are forward looking, but it's been a year. So if your earnings are still down 20-30% from this time last year, it's probably not going to be this turnaround. And that's the issue. It's the whole George Soros talks about reflexivity. The market is not efficient, et cetera, et cetera. So again, I just wanted to show you this. This is an incredible chart to me that look at the problems in the banking sector with unreal losses. We're going to show you where these losses come from in tomorrow's Wednesday stock chart of the day. So I hope you enjoyed this. And like one thing I do like about this new kind of service and doing this is it, because I have to come up with almost a new idea every day. So it does really keep me on my toes, right? Rather than doing a monthly newsletter or something. And I think too, with information, it's much easier to digest whatever I'm doing, a quick 5, 10, 15-minute video than have to digest, 20 pages or 10 pages or whatever it is of a written newsletter, or say a 2-hour PowerPoint presentation, every month. And you're getting more material this way as well. And it doesn't take me a huge amount of time. I work out at home. I just kind of researching and looking at this stuff all day anyhow. So you don't have to. So I hope everybody enjoyed this. I hope everyone has a great Tuesday. We'll have some more information on these kind of what interest rates have done, why these losses are occurring on Wednesday. And everybody take care.